Hi there, it's me, Stephen Thomas, with Reports on Housing, and we're here with another housing debrief. This one is titled Late Housing Peak, Uh-oh. And what do I mean by that? Well, basically, there's been a peak in the inventory. Not all markets have yet peaked, but they will peak definitely this week because next week begins what we call the holiday market. And the holiday market is where there are not a lot of homes that are coming on the market, that's for sure. December is home to the fewest numbers that come on the market, and November is home to the second fewest number of homes that come on the market. And once we hit the holidays, which is typically 1 week prior to Thanksgiving, that's what we refer to as the holiday market, and it travels all the way through the second week of January as soon as all those New Year's resolutions are done, and then people can get back to business as normal. But this is the Southern California active inventory. This is the way all inventories are working in all the markets that we're looking at. And what we're seeing is that you could see this is where the peak's at. Now, this peak beats all other year peaks since COVID. And you can see that right here. This is actually 2023 peak versus 2024. Significantly more homes compared to last year. Now, if you look at 2000, since COVID, 20, 21, 22, this 2024 is higher than all of those various peaks. So if you want to know where it's at, you can actually go back in time. It's lower than where we've been ever before. So this is 17, 18, and 19. It's pretty close to 17. A lot of people like to compare everything to 2019. I don't, because there was actually a few more homes on the market during 2019. I like to look at the averages of those 3 years. That 2017 kind of brings down the average, but it gives us a better look at where inventory levels and demand levels should be. But you could see that even at 2024, it being higher than last year and higher since we had started COVID, it is still lower than where we have been. And you can actually see that in National Association of Realtors numbers, which go back to 1982. Although we have more homes on the market, there's still a supply crisis. There's not enough homes going all the way back to 1982, and we have a lot higher population than where we were in 1982, and yet still we don't have that many homes available across the United States. And this just shows you year over year where we're at. And that purple line is in most markets now across the United States. If you look at the averages, the purple line is this year versus the orange line is 2022. Last year is even below that. That's that blue line. And that red line is 2021. At the start of 2022, you can actually see where it started. It was the fewest number of homes in not only in Southern California, but across the United States. We had never seen so few homes across the United States that were available. But you can see what happened. Interest rates started off the year at 3.25%, and they made their way up to 7.37% by the time we got to October. And you could see how that orange line just really grew fast. And that's because of the switch from a low rate to a high rate environment, that transition. Really, there was a lot of people that didn't know how to operate in this kind of a marketplace. People were wondering if it was going to go into a deep buyer's market. People were talking housing crash, which is a bunch of baloney. But that's what people, that's when there's so much uncertainty. In that uncertainty creates a vacuum, and in that vacuum comes a lot of noise, a lot of people speculating as to where we're going to go from here. And in each of the markets, you can see some markets actually are year over year up significantly. And the ones that look like they're up the most substantially actually had the fewest number of for sale signs and the lowest inventory last year. There's a typical number of homes that come on the market every year, and you could see how off certain counties were, like Orange County and San Diego County. San Diego County had the least number of homes come on the market compared to the number of homes that came on the market prior to COVID in the United States, and had the hottest market in the US as well. LA, right now, that's their present inventory, and it's up 31% compared to last year. And Orange County's up 40%, like I said, comparing it to almost nothing last year. Riverside up 31%. San Bernardino is up 43%. Now, San Bernardino has a high number, and it is also getting close to pre-COVID numbers. And there are some areas across the United States that have hit their pre-COVID numbers or higher than pre-COVID numbers. But if you look at the share aware of everybody, the average market is still well below 2019 and what we call the three-year average, 2017, 18, and 19. But San Bernardino's up 43%. San Diego County's up 52%. Still doesn't have a whole heck of a lot of homes at 4,644, but a lot more than where they were last year. Ventura's up 30%. The Bay Area is only up 12%, but very close to those pre-COVID numbers. Clark County, which is Vegas, up 38%. Maricopa up 39%, also getting close to pre-COVID numbers. And Sacramento's up 37%. If I look at all those areas combined, it's actually up 34% year over year. So you can see there's a sizable move looking at last year compared to this year. And now, what does that mean for the market coming up and for the rest of the year and into 2025? First, I'd like to bring in our sponsor. We welcome back agentmatch.ai. They're the smarter way to find a real estate agent. And this is what agents should know, that you can get connected with customers based on merit, not ad fees. And they promise transparent agent recommendations. And here's what that means. They match you with customers based upon your experience and relevance to what they are searching for. So if you are in California and somebody's searching for a property in Oregon, you're not coming up. That's for sure. It's got to be your local area, and you have to be an expert in that area. So we as in agentmatch.ai, promises customers the most accurate agent recommendations, and they can't fulfill that promise if agents have to pay for placement. So they don't ask the agents to pay for placement. There's no fees. There's no BS. You can visit them at www.agentmatch.ai to create a free profile today and tell them more about your unique skills as an agent. And you can look like a hero when referring out of state as well. My client is moving from California to Tampa. I need to find a referral partner in Florida that specializes in 55 plus communities. They're going to be able to isolate that agent for you. You can use their natural language search to input what your clients are looking for. They run millions of data points to find you 3 agents that match your criteria, and they email you the results, and you can choose which agent looks like the best fit. And natural language processing and proprietary matching, you could tell them what's important to you, and they will take care of the rest. Agent rankings are geocoded to your local areas. Once local, they score the agents on performance and relevance to what your needs are, and they provide you a curated list of 3 agent options. Go to agentmatch.ai. It's the smarter way to find a real estate agent. Now, back to the program and us prognosticating, forecasting where we are going from here. And so Southern California and all the markets, now that they're going to hit their peak, why are they hitting their peak? Because there are fewer homes that come on the market once we officially hit the holidays. I told you, December, fewest number of homes coming on the market. November, second fewest homes coming on the market. And it really starts to hit a crescendo once we hit next week. That's the week prior to Thanksgiving. Now everybody's starting to go on vacation. They're making all their holiday plans. There's holiday music on the radios now. In Los Angeles radio area, the holiday music starts when? Today. So kind of right now is when the holiday market begins. And that's when you get this big giant drop in inventory and in demand. The December's home to the fewest number of homes coming on the market. Also, the greatest number of homes that are pulled off the market, where sellers are throwing in the towel. They're going to start to throw in the towel next week to get prepared for Thanksgiving through the end of the year, because there's a lot of people that are languishing on the market without success. So we're going to watch that inventory drive down from here along with demand. So you could see that purple line, that dotted purple line, we're going to see it sink until it hits its bottom on December 31st. After January 1st, you start to watch the inventory tick up from there. And based upon where we are at right now, on the right black arrow, that means that it's going to come down and we're going to start just under like about 25,000 for Southern California. But you can see what ends up happening is it comes down and we're going to be very close to many markets, very, very close to the 2023 start. Now, 2024 start had fewer homes on the market. The 2023 start had more. That would be last year. And in most markets, you're going to see slightly higher than the 2023 start to start off 2025. Now, we are extremely interest rate sensitive. If you haven't seen that, we saw a bump in demand when we were below 6.5% for 45 days in the month of from August to September, part of October. And there's like a 45-day window there. Actually, in September, the day before the Fed cut the short-term federal funds rate by 0.5%, rates with no points hit 6.1%. And they were at 6.1% the week before that too. So it actually hit 6.1% and it was low, but it was down below 6.5% for 42 days. That was enough for us to see a jump in demand, which has resulted in more closed sales in October than September and a much better market and a lot more that were shoved into pending sale status when we had those rates that were down. So you can anticipate that when we get down lower in interest rates, that it's going to create a lot more activity. There will be when we have interest rates above 7%, the market's frozen. The lower they get below 7%, the more the market thaws. If and when we get below 6%, you will see a real thawing of the market, a masterful thawing of the market. And that's where buyers and sellers and homeowners and people that have been putting off real estate needs for a long time because of these higher interest rates will finally play. And that will happen once we get below that 6% threshold. But you could see they were already beginning to play when we were at 6.1%. So the lower interest rates get, the better the market will be for everybody. And so as far as 2025 is concerned, you could see that most likely our base case is that we're going to be at between 6.5% and 7% for interest rates next year. I would like to be below 6.5%, but that's not where I see it. I actually don't see it staying above 7%. However, because of the new presidential administration and a lot of the policies that are inflationary, they're already positioning towards fewer rate cuts next year, which is why we have a bit higher mortgage rates right now. The only thing that will counter that is data. And we actually think the data is going to be a little bit more softer than what many people are anticipating. They're thinking that the new presidential administration is going to do all these sweeping policies, all of them all at once, which are extremely inflationary, which we don't think that that's what they're going to do. That's our base case, but you never know. So our base case is 6.5% to 7% interest rates, and you can actually see that dotted line where we think that rates ultimately will, or not rates, the inventory will go. It'll be more than this year, that purple line, but it will stay below the 3-year average prior to COVID, but it will be getting closer than it did even this year. And then that will create what we call for the first half of the year, it'll be kind of a seller's market because we're going to peel off homes right now at the beginning. And during spring, we always get this spring activity, but it'll be a mediocre spring at 6.5% to 7%. And then later on in the year, as we accumulate more inventory, the market will become more balanced. Now, there is a chance where the numbers come in and inflation rekindles because of policies. And then what we'll see is that we'll get 7% plus interest rates that stick. And if these end up coming early and lining up with our spring and summer markets, this will really cool the housing market and we will build an inventory across the United States. And you could see that it will bring us all the way to pre-COVID numbers. So if we're stuck above 7%, kind of like what we were this year for many months, as a matter of fact, it lined up between April and July. Just the meat of the housing market had 7% plus interest rates. And when that happens, that really slows things down and it will allow the housing market to accumulate extra inventory to get us back up to where we were prior to COVID. And then if that happens, we have more of a slight buyer's market. Nothing where things are going to plunge. None of these perma bears that have these YouTube sites where they're paid $20,000 to $40,000 a month by YouTube because they have so many people watching them because everybody's rooting for the end of housing and for values to come crashing down. That's not going to happen. We're talking just mild coming down just slightly, and it'd be more towards the second half of the year. It won't even equal like what we saw in 2022 when rates were going skyrocketing higher. It's just, it will be this because so many homeowners do not really have to sell. There's not going to be anybody that's going to be feeling like they're in a pickle and they have to reduce the asking price by a lot. And there's not going to be a lot of bank foreclosures or short sales or anything like that. So you could be rest assured what we refer to as a slight buyer's market, where buyers get to, take a little bit more of their time and have more choices. That is if we are stuck above 7%. But equally, I think an equal chance to that is that we get below 6.5% if the data and numbers come in, all the economic numbers. And if that happens, you can see what happens to the overall market. We don't build that much of an inventory. The inventory just builds slightly and then comes down towards the end of the year, and we will have fewer homes on the market than even at the beginning of 2023 if that happens. So there is a chance of that happening, just like it's a similar chance to the 7% plus in interest rates. And the reason why we actually don't think that we're going to get 7% plus interest rates that stick around for a long time is because the spreads where interest rates like to be long term, there's the spread between the 10-year treasury and where mortgage rates are. And we say that there's this love affair that goes all the way back to 1971. And that love affair shows that the spread is an average of 1.5, and it's very, or 1 3/4, actually 1.75. And it's it's a lot higher than that right now. And that spread has been getting better. So like right now, today, we have interest rates that are right about 7%. If the spread was where it was towards the end of the year, or even at the start of the year, we would have had interest rates closer to about 7.7% today. So right now, the spreads are getting better, which is keeping a lid on interest rates. So it's going to be a lot harder to get 7% and stay above 7% next year. So this is about equal chance as the 7% plus chance, but this is not our base case. Our base case is between 6.5 and 7. But if we did stay at between 6 and 6.5%, it would be a heck of a seller's market during the spring market, and there is that chance of it happening. We see pathways for that happening. It's just not our base case in our trend analysis. So we're very, very data dependent. We're going to be watching all the data, starting with the most important report is coming up the first week of December, and that's the jobs report. We haven't had a good jobs report for a while, and that's because the one that we had at the beginning of November, there was a big asterisk to it, even though we only created 12,000 jobs across the United States. It was because of hurricanes and strikes. And then the one prior to that was really high. So we haven't really been able to see since that really high one that came the first week in October, we haven't really been able to get heads or tails of where the labor market's at, and that's that first week in December. That first Friday is called Jobs Friday, and that'll be very, very important to rates. So we'll be watching that, because here's what happens. When the economy is too hot, rates go up. And when the economy starts to show slowing, rates go down. And this is why we follow it, and we will continue to talk about it. If you like what you see, like this channel, subscribe, tell a friend about it. And if you'd like to subscribe to one of our many housing reports, we just showed a whole slew of all the different counties that we cover in the Bay Area as well. Go to reportsonhousing.com, click on subscribe. The most recent one that came out is a successful approach. Many of those counties haven't got it yet. They will get it at the beginning of next week. A successful approach just shows you the dangers of not pricing a home right exactly at the start. Don't wait to reduce the asking price later. You'll actually net less. It'll take longer and you won't get as much fanfare. So if you'd like a free month and you go to Reports on Housing, the coupon code is PEAK. So, and you can be rest assured, I'm the nerd that's going to be sitting here watching all the data. I will continue to watch it and bring it to you because that's what I love to do. So just wanted to say thank you for joining us for another housing debrief. Hope you have a fantastic finish to your week, and we will see you on the other side.